Hey everybody, and welcome back to the LAGFOREX channel. Now today we have another Learn to Trade video. As it is Wednesday, you know our schedule goes as follows. We have this Learn to Trade video in the afternoon where we just run through something educational. We share some knowledge, typically over a point that we believe is a fundamental part of being a successful trader. We want to portray these over to all of you, make sure that you're picking up on these and implementing them yourself so that you can be successful longer term. Now, today I'm going to be focusing on Wyckoff price cycles. So this is specific to the smart money and Wyckoff approach to the markets. Either way, whether you are a technical trader, a scalper, whatever it may be, this is definitely something that I think will have importance in your trading plan. So make sure you stick it through, watch to the end. And right now I'll dive in and tell you exactly what it is that I'm talking about when I reference Wyckoff price cycles. So quite simply, they represent the up and down movement of the market. If you were new to trading and you loaded up any market, any chart, you would notice that quite simply it moves up and down all the time. Now, when we move up and we are overbought, we are going to distribute. When we move down and we are oversold, we're going to accumulate. We use accumulations and distributions to reverse the market. Now, on top of that, within our moves up and down, we will use reaccumulations and redistributions as stepping stones. Now, what that means is that it will help by introducing more supply or more demand into the market in order to continue that move that they are doing as of current. Now, within this, we can see it within any market and any market condition, whether we are trending up, trending down, or whether we don't even have a trending market, we can still see this in action. But even when we are not trending, we are still going to have an average direction just to do with market structure, but we will dive into that now. I'll go into a live market and show you exactly how we implement this onto charts. Okay, so going into this market, I'm using the Bitcoin to the US dollar. The reason I've decided to use the cryptocurrency is because despite popular belief, crypto markets still follow typical market structure, typical smart money concepts that every single market follows. And I wanted to prove that by using a market that most of you probably didn't think would even follow this. So diving straight in, the first thing we're seeing within the screen is a reaccumulation. Now, everybody knows with Bitcoin, it started off slow and then we had this massive rise, and that's where we get into this range we're in now. So after that massive rise, we've had the reaccumulation here, and then we've started a real Wyckoff price cycle. So the reaccumulation has the purpose, as I said, of introducing more demand. We can dive into that more in a bit and why it does so, but it introduces more demand to cause this move up. But now we're in an overbought state of the market. The smart money operators are ready to reverse price. So therefore, what do they have to do? They have to distribute. Now, why do we know this is a distribution? Because we can look inside and we can start to label all of the events within this. So we will do that now. So looking into this, we have some preliminary supply being entered into the market, evident by some rejection as we move into this area. We then push up for a buying climax. This is where the first climactic price action is formed, the first evidence that supplies enter the market, evident by the automatic reaction, where we have that heavy push down straight after the buying climax. And then, of course, demand is still dominant overall, so we are going to have that reversal after the automatic reaction, come to create a secondary test, which should stop at or near the buying climax, to tell us quite simply that we have reached a level where supply is being introduced. It doesn't always have to stop at the same section, but we can see straight after this secondary test, we had many rejections from this same region. We don't actually have a sign of weakness in this. That is not a required phase. We do have a secondary test in B. Now what that means is that after we've had the reversal again, after the initial secondary test, we've come back up to test this zone again in phase B. Now, the other distinctive thing within this is the upthrust, or the UT. Now this is where we finally manipulate all of that liquidity out of the market. So all of these taps on this region, whether it's the buying climax at this region, anywhere between the buying climax and the secondary test, that is our upper boundaries of the trading range where liquidity lies. The upthrust will blow through that, clear that liquidity, and then typically straight after, this is where we've created the downtrend. So as you know, a distribution, it stops the uptrend and creates a downtrend. Now the up thrust is the extreme high typically in the market. It could be the UTAD, but for argument's sake, the up thrust is the extreme high. Now this is going to be our protected high moving forward. Straight after the up thrust, it's very nice to see price break the previous low in the market, evident by this break of structure. This is a great sign of weakness and a great sign that we are now ready to begin the downtrend. So after we've broken that structure, we then want to look for sells. We want to hope that this high is held. As a result, we can draw out a point of interest at this region and look to get involved in the market. So to me, of course, we want the last buy before sell, which is this, but I'm going to look at the final area where we have manipulation. So as I was saying, within here, we have many taps of a supply zone, let's say. And after this, we have a high volume push from here upwards to clear that liquidity. And this right here would be my point of interest. Now, price doesn't give us a deep mitigation, but it does just tap to mitigate that before going lower. We're not always going to expect a full mitigation in a distribution, just because from the up thrust, so much supply is in that market that is really going to struggle to reverse and make a heavy push up for a deep mitigation. Now, this is the high we've set in the market. So once we set that high in the market, of course, we start that downtrend, and then we come down to an oversold area in the market and we begin to accumulate. Now, after setting this high, we start looking at this low, and if we want price to continue moving upwards, we therefore want price to hold this low. Now, you can see that it did actually come and tap about the same level. Now, this does not invalidate the bullish structure because it isn't a break of structure. It has just tapped to that same level. If it was a break of structure, it would be much more evident by surpassing that level by even more. But just when it taps the same level, this isn't seen as invalidation. Regardless, we come down, we accumulate. If we go inside of this, we can start to actually look at the events within this as well. We have a selling climax, an automatic rally. We have a secondary test. We come back up, we test that upper range of the trading range. We have a few more tests of the bottom parameters of that range. And then here we have that sign of strength. Now, a sign of strength, and this is where it can be confused with a redistribution, because arguably this is an up thrust, you could say. What we've done is we've cleared all these liquidity highs, and that was a point of the move. But within an accumulation, we see this like a sign of weakness, which manipulates early people out of the trading range. The sign of strength, it manipulates early sellers. Regardless, after this, we come down, we set that spring, which again manipulates people out of the market further. We come back, test that spring, and this is exactly where it is primed for an entry on that test of the spring. And then from this point, like the distribution, the spring should be our extreme low and should be the start of the uptrend. So once we move back up and we're starting to break some structure, we can say that, okay, we now expect this to be held. We can actually look to try and get in somewhere within this candle on a buy position. You can see that price on that test came back down, mitigated, and then we had that move up. Now from that move up, we broke the high, which confirms to us that bullishness is continuing moving forward. And then we've distributed again, of course, because once we've reached that overbought state, we have to distribute to reverse. Now, I'm not going to dive into this one. By now, you should be able to gauge what a distribution and accumulation are. But the point being, a Wyckoff price cycle is reaching an overbought state, distributing, reaching an oversold state, accumulating, reaching an overbought state, distributing, and now we can expect price to come down and tap one of our 2 points of interest where it will accumulate, being in an oversold area of the market, and then it will put in its next leg higher. Now, like I said at the start, we're typically going to have an average movement, and of course, because we are producing bullish structure here, our average movement is upwards. Now, we are still having that same up and down movement. We're still distributing at overbought state, accumulating at oversold states. However, we are still respecting the upwards trend, the bullish trend we currently have going. So we are accumulating at or above the previous low, and we are distributing above the previous highs. Now, using simple laws of smart money, I have identified two of the final sells before heavy buys within this market. As I said, we do have stepping stones within the movement. So after we created this uptrend, this right here is a reaccumulation. Now, if I quickly just dive into what this is, we have a buying climax, automatic reaction, some secondary tests in here, a big sign of strength. Come down, we have that spring, and then that movement upwards. Now, the reason for this is because we create this area of liquidity here. The spring comes down, it manipulates that area, and then it allows the smart money operators to gain some buy positions to help continue and bring more demand into the market to continue this movement upwards. So I'm expecting the spring of this to be mitigated because within this, we didn't have that test of the spring. So we're looking at a mitigation for that. You can see how perfectly this wick came down, tapped into it and reversed. We'll have to see if price now wants to continue holding this region. If not, and it does decide to break this, we'll then look at this region for an accumulation itself. So that is exactly how we look to trade these price cycles. We have to identify what trend of the market we're in. So with this, our average movement is upwards. We are uptrending. So we know that we want the high speed broken. But then when price reverses, we can find points of interest and wait for price to accumulate at its oversold state and ride that uptrend up to their previous high. Now, my purpose for creating this video is because I don't think people realize how much dominance Wyckoff has in the markets every single time we see a reversal. Now, I am on the 1 day here, but this can be applied to any single time frame. Quite simply, anytime we reverse, we have to create a Wyckoff schematic. All that the up and down of the market is just Wyckoff price cycles. This would be the same in a downtrend, in consolidation. We are now just looking at bullish trends, but we will see this all the time. In order for price to move up and reverse, we must distribute. In order for price to move down and reverse, we must accumulate. So moving forward, when you're looking at a chart, identify the structure and then begin to identify how Wyckoff's price cycle law is being implemented in that market. Look for your distributions, look for your accumulations, find out regions of reaccumulations or even redistributions, because these should be our main points of interest. Whenever we create a schematic, we know that smart money presence is there, which is typically always going to mean that we have unmitigated positions left. Now, in markets, it's not always going to be this clear. The distributions, accumulations, reaccumulations, they won't always be this clear. However, we must identify them so that we understand where the order flow lies in the market and we can begin to understand how to trade it. So just to put that as an example, we can see here that I have marked out my 2 points of interest as those springs in the accumulation and the reaccumulation, because this is where a heavy manipulation has taken place. So the smart money operators have opened large sell positions that have not yet been mitigated. So when price comes down, the only 2 regions that it needs to mitigate, or major regions that it needs to mitigate, are these 2 zones here. So moving forward, I could recommend that you set alerts at these, wait for price to move to them, look out for an accumulation, and then we can expect that price will put in that next leg of the Wyckoff price cycle and come to break this high. So for all of those people that think Bitcoin is now being disregarded, is no longer in a bull run, I completely disagree with you, because following simple market structure, we are still putting in bullish structure and we're yet to invalidate that at all. Regardless, without waffling on too long, I hope you guys have enjoyed this. I hope you now understand what the Wyckoff price cycles are. If not, go online, search it up, do some more research. A last disclaimer before we end the video: none of this is financial advice. This is simply me showing you how I analyze the markets and the methodologies that I use in order to help me predict the probable future trend. With that being said, I hope you have enjoyed, and I will see you next Wednesday on the next Learn to Trade video.